Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat. Paris milling wheat. 10 weeks ago, the market created a cusp after a big, long move down. We had a resultant break higher, something I cautioned about 9 weeks prior. Prices rose up through stratified layers of resistance. Some of them seemed, and still seem, quite dense, such as the congestion area 238 to 242 containing the March 2013 high at 240 and the nearby short medium moving average currently at 244. Then also the February 2013 high at 247, the now flatlining medium moving average currently 244, followed by another congestion band between 250 to 255, this time with the 2013 high at 253 within it. After that, we had and still have another small congestion area between 258 to 260 with the 2011 high within it at 258, followed by a bit of a deserted area up to some of the most heavy-looking congestion I've seen, or that is available, and that's between 267 and 270. All those numbers are enough to be going on with for now. The question I posed 3 weeks ago was whether the moves lower had managed to, by their nature, trigger the beginnings of a new bullish movement. The weekly key reversal down pick back 6 weeks ago looked like the answer was for a move lower, but the response, really the action from late June to late July, ended up with a small rounded bottom pattern. And prices moved up all the way to test that super heavy overhead congestion between 267 and 270. Where they failed to make an impression, dropping back down to the March 2013 high at 240 even, and slowly rising short medium moving average currently 244. Interestingly, the action since 2 weeks ago to date has raised the question as to whether the whole of this action is a bear flag in construction. I am not sure yet, but if it does happen in between this commentary and the next, then a potential target below may be in the 227 zone. Now, I've spoken here for many weeks about the formation of a possible descending scallop pattern here. I said 7 weeks ago that this daily chart had the makings of a better example of a descending scallop pattern than in the other grey markets. However, the hesitation to form the lip, whilst fairly minimal, had affected the idea of this pattern. Additionally, the recent weekly key reversal down had helped the case for a descending wedge pattern quite a bit, but the spanner in the works has been the construction of the recent small rounded bottom, which had hindered the case for a descending scallop pattern. However, unlike say Chicago wheat, the impact here had seemed less onerous. So for now I will still have the possibility of such a pattern, but it will mean that what happens now in a future construction of this descending scallop pattern may be under more scrutiny. Now, all this action since late May to mid-July allowed me last week to draw a bullish shift picture, which is highlighted in dark blue on my daily chart. The market is in between the lower time below, currently 240 even, and the middle time above, currently 257. I am once again very cognizant that this pattern throws another spanner into the works regarding the idea of a descending scallop pattern. But I would rather say what I saw than just pursue one avenue which might finish up being a dead end. Now, the final thing I have to say is a big picture item. This market is still well within the big bear channel, currently 209 to 284, highlighted in bright green and originating from October 2022. London, UK feed wheat. The recovery rally higher from the mini reverse head and shoulders pattern formed roughly over the middle of May to the middle of June petered out in late June, with prices turning back down, not wishing to even look at the next major congestion overhead of the then declining medium moving average, currently 189.5. However, the decline halted ahead of the dip formed from the head of the reverse head and shoulders pattern. Looking again at this drop in early July, I am still not sure why prices went down that far or why they halted where they did, when it looks as if prices could easily drop to the June low or even the July 2021 low at 164 even. However, this is what they did, and I can't argue with that. This failure to exploit the move lower led to the recovery back up at the start to the middle of July, though the move up was a bit dramatic, even if it was the final part of a double bottom pattern. It was in this rise that prices met their first real obstacle in a declining medium moving average again. This managed to hesitate the market 4 weeks ago, around this moving average. But 3 weeks ago, prices took off again with an unusual shooting star pattern, type 2 bullish. Prices rose up through the March 2013 high at 205.05, the 2022 low at 206.5, and even the 2013 high at 215. But it was just above this congestion that 3 weeks ago, and again 2 weeks ago, were met and halted by a significant resistance of the declining long moving average, currently 212.25, along with some nearby Fibonacci and other congestions. Now, the subsequent fall led to the construction of one, possibly two patterns. A definite small double top, Adam and Eve type, over the end of July, and an island top, though I'm bending the rules for this island top idea a little bit. Okay, so I now wish to look at the bigger picture, as it shows some interesting perspectives onto the recent action. To start with, the action here is obviously different on this daily chart when compared to the other grain markets. I also mean the chance of a possible descending scallop pattern here is different than what has happened in the other grain markets. The opportunity for such a pattern forming in London feed wheat is still there, and the very recent aberration seen in this pattern, specifically the dip in late June and into early July, did not seem to be influential on the overall pattern. So where does that leave us now? Well, I suspect the descending scallop pattern may be coming to completion in a not too distant future. If that indeed is what is going to become, so the action once again over this coming new week and the week after may be crucial in deciding the outcome of this pattern. I am specifically interested in whether this action for this descending scallop pattern should start from the high in February or should it start from the high in October. This judgment call is still yet to be made. Now, one other point. It increasingly seems that the market is getting caught between the overhead long moving average and the medium moving average below. Until these two roadblocks are removed, whichever one it is, and obviously be aware of false breaks, well, until they are removed, then we will, as we have seen this week, be heading nowhere. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.